Hi. We're going to get started again, if I could have your attention. Well, I hope everybody's had a great day. I've had a chance to talk to a lot of you in hallways between sessions and everything like that, which is my favorite part. So it sounds like it's been very, very engaging, a lot of exciting talks. And I'm really excited about our afternoon keynote with Marcos López de Prado, who is really, I think, a sort of singular figure in the field. He's extremely well published, and I think my favorite thing about Marcos is he's just incredibly generous with whatever he learns. So in the field of quantitative finance, historically, is just extremely secretive and very, very difficult to make contact with experts. And I think for his entire career, Marcos has really gone against that grain. He's been very, very open with his findings. He's a bit of a burr in the saddle for academic publishers. He's always challenging the state of the art in the field and demanding scientific rigor. And I think that is exactly what the field needs. So I want to tell you about his background because it's remarkable. Before I do that, I think a bunch of you were able to pick up his new book, which is Advances in Financial Machine Learning. It's really an incredible book. It's very near and dear to my heart, and I do mean my heart, and the rest of Quantopian. He basically lays out the vision and business plan and scientific method for our asset management business in that book in the early chapters, which is incredibly inspiring and extremely helpful. So I really highly recommend that book. And I want to tell you a few things about Marcos. So he's the Chief Executive Officer at Quantitative Technologies. He's had a pretty remarkable year. He published his book, but he also bought and spun out his business, Quantitative, out of Guggenheim Partners' quantitative investment strategies business. So he's been running, no big surprise, machine learning strategies there. And this year he was able to spin out after managing up to $13 billion in assets with a track record to go with it. And Marcos is also a research fellow at the Lawrence Berkeley National Laboratory, which is in the US Department of Energy. And you'll see if you read his book, he talks a lot about borrowing from the National Lab model in the search for alpha, which I think is extraordinarily timely for the field. He's also a top 10 most read author in finance, according to SSRN. And as I mentioned, he's just very well published. He's published dozens of scientific articles on ML, supercomputing, and he holds multiple international patent applications on algorithmic trading. He earned his first PhD in financial economics in 2003, and why only get one? So he got his second PhD in mathematical finance in 2011 from the university. God help me with the pronunciation of this Spanish word I'm about to say. Universidad Complutense de Madrid. Close? You can correct me when you get up here, Marcos. And he is the recipient of Spain's National Award for Academic Excellence in 1999. And he had his postdoctoral research at Harvard and Cornell. He's also a great guy. So why don't you come on up, Marcos?
Thank you for having me. You guys are my favorite group of people, and let me tell you why. If there is an inefficiency in financial markets, anybody should be able and allowed to arbitrage it away and correct it, right? These are our markets. This is where people transact and exchange information. And the status quo today is that people are not allowed to do that. In order to exploit and correct these inefficiencies, typically you have to join a firm and you have to play by the rules. And if you're not part of the right clubs or you don't have the right background, they may not like you and they may not want you. And that sounds wrong in the 21st century. And here comes Quantopian, which is a wonderful experiment. a wonderful experiment not only in the quantitative space, but also in the social space, where the goal is to disintermediate these old structures. And that's why I'm very optimistic about Quantopian, not only about what Quantopian can do for investors, but actually what it can do for modernizing financial markets and breaking with the old paradigms. That said, we are all, I believe, very interested in new technologies and how these new technologies can modernize finance. In particular, today's presentation is about machine learning. There is a lot of hype about machine learning. Not all of it is realistic at this point. And the point of this presentation is to highlight a number of areas where machine learning can go wrong. I think it is quite clear that machine learning can be an incredible, irreplaceable tool for identifying inefficiencies in financial markets. But it also, with this power, comes certain responsibilities. And it is when you're a researcher, you have to make sure that this power doesn't end up being adverse to you. All right, so let me go straight to 7 issues that I find frequently dangerous as it relates to machine learning. The first one is a little bit philosophical, is how should we organize our work? What is the best way to organize work when you're conducting research applying machine learning? And the old paradigm that comes back to the 1980s is a hedge fund will hire a bunch of portfolio managers. In the 1980s, many of them were discretionary portfolio managers. And these discretionary portfolio managers will work in silos. Why will they work in silos? Well, it makes sense. A discretionary portfolio manager is someone who doesn't really know where he's making these decisions. If he knew why he's making these decisions, he would have a system, and therefore he would be a systematic portfolio manager. However, since the decisions are not necessarily systematic and they are discretionary, they are based on, in many cases, hunches or gut feeling, how can these portfolio managers reach a conclusion? Well, very often they don't know why they are making that decision. They cannot rationalize why they are making the decision. Therefore, it's very hard for them to work together. That's why it makes sense for hedge funds to have these portfolio managers working in silos so that the diversification potential is exploited that way by having different portfolio managers making decisions and not influencing each other, not trying to convince each other. Now, when you bring this to the quant space, it doesn't really make sense, right? The whole point of science is to build a dialogue where we can reach objective conclusions through discussion and testing. So why would anybody ask scientists to work in silos? It does not really make sense. It is not how laboratories work. It's not how universities work. The whole point of science is to have a discussion, a debate, and to reach common conclusions. So why would hedge funds do that with quants? Well, one answer is because that's what has been successful with discretionary portfolio managers, and they just think, well, let's repeat this protocol, this procedure with quants. It also has to do, of course, with secrecy, with not allowing that some quants take ideas from other quants and essentially the secrets go away. And secrets are very important to hedge funds, especially when they are automatable, right? When you can take the secret out of a place. So it has to do, to some extent, with secrecy. But I find very often that the argument goes more like, well, you know, everybody should stand on their own feet and come up with their own ideas, and they should not cooperate. Well, why this is disadvantageous? Because essentially, building a quantitative strategy is much more difficult than making discretionary decisions, right? Building a quantitative strategy involves a tremendous amount of effort. And when you put these quants under a lot of pressure to come up with a strategy within 6 months, essentially what I've seen very often happens is that they will come up with strategies that are either the result of backtest overfitting, just running millions of simulations and reporting to the investment board whatever seems to work best, or it will be some strategy based on some research paper. Very often will be some factor model that it has a lot of support in the academic community, but the reality is it may be an overcrowded strategy with a low Sharpe ratio. Eventually what happens is that results are not where the backtests suggested, and investment boards become disillusioned, and eventually they shut down the operation. So that happens very often, right? And this is what I call the Sisyphean quants, right? This is, if you remember in Greek mythology, Sisyphus was condemned by the gods to perform this daily routine of rolling a boulder up the mountain only to see the boulder roll down at the end of the day, and he was never able to reach the summit. The promise was that if he were ever able to reach the summit, he would finally be liberated. But for the whole eternity, Sisyphus was condemned to do this futile effort where there was no hope of succeeding. And I'm not saying that there is no hope of succeeding when you are on your own and you have no support and you have no access to clean data sets or computing power. It's becoming increasingly difficult to succeed in such environment. It would be equivalent to having a factory worker at the BMW factory, and you ask that worker to one day be a welder, on another day to be a mechanical engineer, another day to be an electrical engineer, and eventually build the car with all these shops around him. Well, that's not how car production works, right? Typically what happens is someone is at the station and specializes and is the best that he or she can be at that job. The same happens to work, or seems to work quite well in finance. You can have people who are specialists in supercomputing, and they will know a lot about parallel processing and how to vectorize algorithms. And there is so much to learn on that respect, right? There will be people who specialize in production software, people who specialize in data cleaning and curation, people who specialize in doing research, coming up with what are the important features that explain a phenomenon. There will be people who specialize in backtesting and think about backtesting, all that involves, right? Transaction costs, the possibility to trade or not, what is the probability that you would get a fill, at what price. So all these people can specialize and work together as a team, right? And that seems to be more efficient than asking everybody to be the best they can at everything. So that's what I've seen that seems to work in the new kind of quant firms, where people are truly the best they can at performing very well divided tasks. And let me tell you one anecdote about the Manhattan Project. The Manhattan Project involved tens of thousands of scientists. And even though it was a very complicated project that involved cutting-edge science at the time, they were able to divide the tasks involved in that project to such level of granularity that even high school students were able to contribute to the project. And that was Richard Feynman's job at the Manhattan Project, was to coordinate the work of high school students. And what was their work? To calculate the yield of the bomb. Essentially, they were performing the operations, right? They didn't have supercomputers, so they had a bunch of kids solving operations that in an aggregate fashion would determine what is the yield of the bomb. So that is the kind of granularity and subtask partitioning that was achieved at that project. meaning that there is no task that is so complicated that cannot be divided into tasks that are much, much simpler. And that seems to me something that, especially when you have access to a large community of people collaborating, would be very appealing. Pitfall number 2 is integer differentiation. So you take any paper in financial economics written over the past 80 years, and the first thing they do is always they compute returns. They are trying to price securities. Let's say that they are trying to price the value of stocks. The first thing that they will do is they will compute the cross-section of returns. If this is a fixed income research paper, the first thing they will do is they will operate with yield to maturities, option-adjusted spread, you name it, some sort of changes in the spreads, right? What is the spread? What is the yield to maturity is essentially a duration-adjusted price for a bond, and they will work with a stationary series where they make the series stationary by computing differences of the yield. The same with a paper dealing with option pricing. Well, they will compute differences on the implied volatilities. It's always about computing integer differences. And when you think about it, it doesn't really make sense. I know everybody does it, and every paper starts like that, but when you think about it, it doesn't really make sense. The level information, the prices, implied volatilities, yield, they contain memory. And when you're trying to make a prediction, memory sounds like one thing that you want to preserve, right? You want to know how you reach that level in order to understand what the price is going to do in the future. But the first thing that people do when they compute a difference is to eradicate that memory. The memory is gone. You compute a return, and what you're doing is you're computing you're dividing the price of today by the price of yesterday. So whatever happened before yesterday is eradicated. It's entirely removed. Now, of course, this is done because you need to work with a stationary series. If the series is not a stationary, then the algorithm will not be able to learn from comparable examples, right? You will not be able to derive a distribution that is stable. And if the distribution is not stable, the algorithm will not be able to identify patterns that are comparable to whatever observed features you have today. So there is, of course, a reason for doing integer differentiation. The problem is that when people compute a difference, and the difference is an integer difference, you achieve a stationarity at the cost of wiping all memory out. So the question I asked myself a few years ago is there an optimal level of differentiation that allows you to preserve the maximum amount of memory? Rather than differentiating with an integer, so for instance, the return between yesterday and today, is there any fractional differentiation, any level of differentiation between 0 and 1, right? When you differentiate by order 0, you are working with levels. The series is not stationary, so that's bad. When you work, so the series will have full memory, but it won't be a stationary. When you work with differentiation 1, the series will be a stationary, but we have no memory, so bad too. There must be somewhere in between, right? There must be somewhere in between a degree of differentiation that is optimal in the sense that achieves a stationarity at the minimum cost in terms of memory preservation. And that's what you see in this plot here. You can see a blue line that is somehow a mix of returns. It's somehow a mix of white noise and levels, right? So you can see how the green line is the price of the S&P between 1998 and 2015, sorry. And the blue line is the series where we have a fractional differentiation, where the order of differentiation is 0.4. So the blue line is both stationary and still it incorporates a lot of memory. You can observe that when, after 2008, when the S&P plummets and loses something like 40-something%, the blue line remains, there is a lot of noise, but still the values are depressed for a long period of time until eventually that memory from the immediate history it wanes. So let me present you the same idea with a different plot. In this plot, we have two lines, the orange line and the blue line. The blue line is the statistic from an augmented Dickey and Fuller test, an ADF test. And as you can see, that the value goes from around 0 to something like minus 50. So the value is around 0 when you have no differentiation, so the series is non-stationary. And then by the time you differentiate, you compute the return, you jump from 0 to 1, all of a sudden the value is minus 45 or minus 50. Now the series is completely stationary. I mean, it's like you were expecting to achieve a level of minus 2.3, right? When the ADF stat is around minus 2.3, you already have a 95% confidence that the series is stationary or that you have rejected the null. Now, the orange line represents the correlation between the differentiated series and the original series, right? And when the series is non-differentiated, the correlation is 1, because the correlation between prices and prices, okay? When you differentiate with an integer differentiation of order 1, now that correlation drops to 0.05 or so. So what happens in between, you can see that at the level of around 0.4, you have a series, actually 0.35 in this case, you can achieve an ADF test of around minus 2.86, while at the same time, the differentiated series, fractionally differentiated series, has a correlation of 0.995 with the original series. So essentially, you achieve two things. The fractionally differentiated series is very close to the original series, and yet is stationary. Is this a unique phenomenon? Not at all. There is not a single future where you need to compute returns. Meaning that for the past 80 years, people have been publishing papers out there where the series were massively over-differentiated. There is not a single case. You can see here more returns. Out of the 100 most liquid futures worldwide, the maximum level of differentiation that is needed is 0.5. It's never 1. And in fact, the median is around 0.3, 0.2, 0.3. So think about it. The level of differentiation that was needed, that was justifiable in order to achieve a stationarity, was 0.2, 0.3. All the rest, 0.3 to 1, just was for the sake of removing memory, not for the sake of achieving a stationarity. Is it therefore surprising that most academics claim that markets are perfect? No. Markets appear to be perfect by construction. Once you remove all memory, markets become unpredictable. It's not that markets are unpredictable. Markets are predictable. We should be able to predict the markets. But they become unpredictable once you remove all memory. So it appears to me that the efficient market hypothesis actually may be the wrong conclusion from utilizing a wrong technique. All right, pitfall number 3 is inefficient sampling. In many papers, you see that people, academics especially, they utilize, they take samples based on a chronological clock. Essentially, they will take samples every day or every hour or every minute at a constant pace, right? At a time-based constant distance. Now, that doesn't really make a lot of sense because Clearly, markets do not receive information at a constant rate. Markets receive a lot of transactions and volume at the open, then there is a valley around noon, and then volume spikes tremendously around 3 p.m. until the close 4 p.m. New York time. I'm talking about equity markets, but in oil, it will be the volume will spike around 1 p.m. in fixed income 4. Depends on the market, but essentially this valley feature is very characteristic. Now, when you sample, it makes sense to sample data when there is information to be extracted. I mean, why would you sample when there is no information to be extracted? Actually, that's a bad sample, right? It's a bad sample because it just leads to redundant observations, observations that do not bring information. It's counterproductive, in fact, to sample observations when there is no information to be extracted. So alternative approaches are to compute trade bars, volume bars, dollar bars, volatility on runs, ordering balance, entropy bars. The book describes many of these. Let me give you an explanation of one of them. So for instance, you could compute dollar bars where essentially you're forming a bar whenever you accumulate a dollar amount traded on a particular side. So whenever markets are very balanced in terms of buys and sells, you're going to produce bars whenever a particular dollar amount has been traded. Now, suppose that all of a sudden an informed trader arrives to the market, and this informed trader thinks that the price will go up and therefore becomes a very aggressive buyer. As a result, now the volume will be very imbalanced, and this kind of sampling mechanism will sample more. It will sample more because it will be easier to generate an amount of trading on a particular side of the market, in this case, buyers. And that's exactly what you want to do. Someone has arrived to the market. This person has asymmetric information, is utilizing this asymmetric information to press a particular side of the market. The algorithm detects that and samples more. Why? Because you want to learn what that person knows, right? This person is acting this way because he has asymmetric information, and you want to join that. You want to extract that information that he knows of and he's incorporating into the price. Let me give you an illustration of why these sampling methods seem to work well. There are here 3 plots. There is a blue, a green, and a black line. The black line is the number of bars per day of a particular size, let's say 50 on average per day, that you would extract if you use tick bars. If you, let's say that you compute, you sample 1 bar every time that a certain number of ticks is exchanged. Now, as you can see, this line is quite far from a flat line. It starts at a level of around 25 and then goes all the way up to 100, and then it goes down to around 50 over time. Why? Because this bar is affected by high-frequency trading. As high-frequency trading has become a prevalent technology in financial markets, the order size has decreased. Because there are more ticks for every given amount of volume traded, as you can see, beginning in 2007, it goes up, and then around 2012 reaches a peak, and then there was a change in the fixed protocol that reduced the number of fragmentation in the trades. So then this line decreases, but it's really a function of changes in the fixed protocol. So we would like to avoid that, right? We would like to avoid that. The sampling frequency is a function of new technologies arriving or changes to protocols. So that's where the green line arrives. That's volume bars, right? And volume bars take a sample every time that this particular volume, not tick, volume, number of contracts is changed, takes place in the market. And as you can see, this series is now much more stable. Now, the blue line is even more stable than the green line, and that's dollar bars. Essentially, now we're taking into account information about the price that has the dollar amount exchange, not only the volume information, but also the price information. So that's a much more stable way of sampling. And it's stable and is less dependent on technological features or price action. So pitfall number 4, wrong labeling. Very often you see in the financial literature that people label observations from financial markets in a rather automatic way, as if they were dealing with faces from Facebook or dealing with some sort of non-financial data set. So essentially what they will do is they will take, they will make some observations, and then they will sample these observations based on what is the return over a given fixed horizon, so over the next 10 bars or 10 days. Well, that doesn't really make sense, because when you think about it, number one, time bars do not exhibit good statistical properties. So when you compute returns based on time bars, these series typically will have will be heteroscedastic, so they won't have a constant variance. They will exhibit substantial serial correlation. Well, why? Because there will be many observations made during the night where there is very little volatility, and then all of a sudden some observations during the day, which again they will have they will exhibit this sort of serial correlation. The distribution will be non-normal. It will be skewed. There will be skewness and kurtosis. So sampling with time bars is a bad idea, and we have seen this before. Now, labeling based on a fixed time horizon, it just incorporates, once again, wrong information, right? You should label not based on what happens over the next 10 bars, but whether you achieve the objective of a position under those circumstances. So let me give you an example. By the way, that's what I call the triple variable method. So this is the alternative to what is being done in most papers out there. The idea is you are going to label an observation based on the outcome as if you had a position at that point in time. So you form 3 bars, you form 2 horizontal barriers, one up and one down, and then a vertical barrier. And essentially this incorporates the information that you would follow if you were holding a position, right? The upper barrier is a profit-taking level. The lower barrier is a stop-loss barrier, and the vertical barrier essentially just tells you we held this position for a particular horizon, and now it's time to move on. Now, when you do that, what is the difference? The traditional method of a constant time barrier or time horizon essentially is equivalent to holding a vertical barrier without the horizontal barrier, You see that, right? If you are holding a position for the next 10 days and you don't care what happens in between, essentially this is equivalent to having no barriers, no horizontal barriers, and you just label based on the outcome at the end. Now, when you incorporate the 2 horizontal barriers, what you're doing is you are incorporating information about the path, right? Now labeling will be path dependent. Essentially what you're doing is you will label an observation as a 1 if you would have taken a profit, if you would have made a profit at that, after holding that position. The observation will be labeled as a -1 if you would have been a stop out. And who has not been a stop out at some point in time? It's very healthy, right? So not incorporating that health information into your machine learning algorithm probably is a bad idea. And you have to give it to the academics. Only an academic would label observations without taking into account the possibility of a stop out. Now, anybody managing a portfolio for real knows that you have to take into account the possibility of being a stop out, right? It doesn't matter where the price is After 10 days, if you were managing a position during the flash crash, you know that the stop outs can kick in any time. Now, how is this relevant? Well, there is a lot of interest these days for what I call quantamental firms. And let me tell you one natural way that firms can incorporate information, how fundamental firms can actually use machine learning methods in their daily decision making. One way is to add a machine learning layer to your traditional fundamental decision making. Suppose that you work for a firm that is very fundamental, where people make decisions based on either book information, accounting, or traditional economic models. And now, what you would like to do is not to challenge the decisions made by those models, but what you would like to do is to determine what is the betting size. How much should we bet on this forecast made by the fundamental model? So that's what I call meta-labeling. Meta-labeling is a very nice way of combining adding a machine learning layer to any sort of theoretical model. Whether the model is econometric, economic, fundamental, it doesn't matter. The role of the machine learning algorithm is to figure out how much should we bet, if anything at all, in this prediction that the algorithm has made, or that this primary model has made. Now, this is very helpful in the following sense. Suppose that you have an algorithm that has low precision but high recall, right? This is an algorithm that is able to identify almost all positives. However, it has a large number of false positives, right? And essentially, like most economists who predict 20 out of the last 10 recessions, right? And so that's an example. Economists are an example of an algorithm that has high recall and low precision. And now what we would do is we would incorporate a machine learning algorithm on top of that economist. And now the machine learning algorithm is going to figure out how much should we bet on the forecast made by this particular economist, given previous examples of predictions made by this economist. And why is this helpful? Because if you have a model that has high recall, it's not so important that it has low precision. Now the machine learning algorithm will reduce the recall in exchange for increasing the precision. And there is an optimal level out there where you can maximize the harmonic average of the two, of precision and recall. And that's what this machine learning algorithm would do. All right, pitfall number 5, weighting of non-IID samples. Finance is very funny as it comes down, as it relates to machine learning. In a traditional machine learning application, like for instance, medical research, suppose that you're a doctor and someone asks you, well, what are the features that are conducive of high cholesterol? What you would do is we would take here a sample of everybody, samples from everybody here in the audience, and we would label them, right? And then we would ask some questions about what is your diet, what are exercise routines, genetic predisposition to cholesterol, etc. You would ask a number of questions, and you would try to identify these features are predictive of your observation that is in that tube, 1 tube per person, right? Independent samples, 1 tube per person. But finance is not like that, right? What happens in finance is that essentially someone takes all these tubes and messes them up. And now what happens is that the blood contained in tube number 9 contains information from subjects 8, 7, 6, and 5, and tube number 20 contains a sample from subject number 20, but also partly a sample from subject 19, 18, 17, 16. That's finance. We don't have access to clean observations. Why? Because financial series are multi-collinear. They exhibit serial correlation. They are non-normal. They are all contaminated. Right? There is a lot of stuff going on in financial markets at any point in time. And we can never isolate the effect of features. It's everything combined, right? So there is no such thing in finance as collecting a sample from a particular individual and then collecting an independent sample. Why? Because the cross correlations are tremendous, and then to make matters worse, even the serial correlation is substantial. Now, why is this relevant? Well, it's relevant because think about some of the major breakthroughs in machine learning these days, right? When a couple of years ago, algorithms were able to identify faces very effectively, or drive cars, even though that track record has been tarnished recently. Now, when you think about it, here's my friend Luna. My friend Luna can recognize faces very well. I know it because she doesn't bark at me. She barks at the neighbor. However, even though my dog Luna can recognize faces as well as Google's algorithms, my dog Luna, she cannot manage my investment portfolio. Well, she can manage my investment portfolio more or less as well as most portfolio managers out there in Wall Street, but that's not exactly what you would expect anyway. I don't pay her anywhere close what a machine, a Wall Street portfolio manager would expect or be satisfied with anyway, unless they just want to get some, cold meal at the end of the day. So this is the problem, right? The problem is that what appears to be breakthroughs somewhere else, like driving cars and recognizing faces, there are plenty of people who can drive cars. There are plenty of people who can recognize faces. But there are not many people who can manage portfolios. It happens to be a very complex problem. And part of the reason it is a very complex problem is not because the system is chaotic. There are chaotic systems out there that can be predicted using machine learning. If you read the press over the past week, actually, for instance, there were a group of scientists who were able to predict a chaotic system like widespread of, the spreading of a wildfire over multiple Lyapunov cycles, which essentially are full cycles of uncertainty. It's like 8 cycles. It was incredible. A machine learning algorithm could predict a chaotic system. This is something that nobody thought it would be possible. So machine learning clearly is an incredible tool that can solve for chaotic systems like the economy. But the problem with finance is that the data sets are not as good as the data sets you can form in physics. And part of the difficulty is exactly what we are discussing in this slide, right? And it is that observations are non-unique. These observations are not independent and identically distributed. And one thing we can do is to control for that lack of uniqueness. Essentially, what we can do is we can determine whether the observations are similar to other observations we have made. How? Well, suppose that, for instance, you observe some features, and now you're labeling these features based on the outcome that occurs over the next 20 bars, right? Or using the triple barrier method until one of the barriers is hit. Now, the next observation has some overlap information, right? The next observation is going to look at, let's say, the next 21 or 23 bars. And there is an overlap, and you can control for that overlap. Essentially, you can determine what is the amount of shared information between these consecutive observations. And once you do that, something very interesting happens, and it is that once you sample, when you conduct your cross-validation, once you sample observations taking into account the redundancy, the uniqueness of the you sample more observations that are more unique, then what occurs is that all of a sudden your out-of-sample accuracy increases dramatically, right? Meaning that if you conduct a cross-validation and you don't take into account the uniqueness of the observations, your accuracy is not going to be as good as if you introduce that additional information to your classifier. So that's something that not many people do, but definitely it has tremendous benefits. Now, since we are already talking about cross-validation, let's discuss one essential problem in financial data sets, and that's leakage. This is why, one of the reasons, many backtests look wonderful in sample, and then you deploy the strategy and it doesn't work out of sample. So one of the reasons is because the machine learning algorithm tested something, learned something in sample, and then tested those fit parameters out of sample in a testing set, but the testing set had leaked information into the training set, right? And how does this happen? Well, in finance, very often. Why? Because the series exhibit zero correlation, and the labels are overlapping, and as a result, when you combine these two features, zero correlation and overlapping labels, very often there will be some examples in the testing set that are sharing information with samples in the training set. What can you do about it? Well, one thing you can do is, of course, as we said before, to try to control for the uniqueness of the observations, but that doesn't suffice. Another thing that you need to do is you need to perform two operations. One is called purging, and the other one is called embargo. The difference between the two is purging has to do with removing from the in-sample observations that share information with other observations in the testing set. So that's something that we can do because we know what is the degree of overlap between the labels in the two sets. And the second thing is embargo. Essentially, this is necessary when your testing set predates the training set. So for instance here, as you can see, the testing set is between two training sets, one that happens before, one that happens afterwards. And you need to remove that overlap, which is what purging does. But in addition, on the right side, there are some observations in the training set that are after the testing set, and they should be removed. Once you do that, what happens is that, well, typically sharp ratios decline in the backtest, because that's what should happen. Essentially, you are removing the effects of overfitting, of leakage. And by the way, one thing to determine at what point you have purged and embargoed enough is when the sharp stabilizes and it ceases to decline, hopefully above zero. All right, pitfall number 7, last one. My favorite, back to overfitting. And this is what I call the most important plot in finance. I call it that way because it has helped me a lot during my career. Essentially, the way this plot is generated is as follows. Suppose that you perform a number of experiments, say 1,000. You perform 1,000 of backtests. And these backtests are trying to determine the profitability of various strategies, whether they are mean reversion, trend following, looking for calendar patterns, machine learning, you name it. They are trying to identify a strategy and compute the performance of that strategy. Now, the feature, where do these series you are using for developing this strategy, where do they come from? Well, suppose that these series are actually random walks. They are unpredictable. So essentially what we are doing is we are just computing investment strategies on series where, by definition, there is no investment strategy. They are just unpredictable. What is the sharp ratio that you expect to achieve? Surprisingly, the answer is not 0, right? When you conduct 1,000 experiments on a series, on a single series, where the series is unpredictable, the expected maximum Sharpe ratio is around 3. Isn't that astonishing? Remember, the series is unpredictable. There is no strategy. And yet, the expected maximum Sharpe ratio is 3. Well, if you conduct 1 million simulations where, today to perform 1 million simulations is trivial, 1 million backtests, now the expected maximum Sharpe ratio is 5. And what this tells you is the following. Whenever you read a paper in the Journal of Finance, in any of the best journals anywhere, how many trials did the author conduct? Nobody knows. Most likely the author doesn't know because he didn't keep track of them. Some of these papers are written over many years. The referees had no clue, and everybody assumed in their statistical tests that a single trial had taken place. Essentially, that's what happens when we utilize a confidence level of 95%, a significance level of 5%. We set the thresholds for rejecting the null at the 5% probability of a false positive, under the assumption that a single trial has taken place. Now, this is something that it has been known for a long time, right? Already 4 or 5 years after the current framework for conducting statistical tests was set up, people realized that these thresholds for rejecting the null couldn't remain constant as you conduct multiple tests. So for the past 90 years, people have been in finance, people have been conducting multiple tests without adjusting for the rejection thresholds. So this is something that it doesn't happen anywhere else, right? In medical research, in physics, people conduct multiple tests and they all adjust for this phenomenon, the possibility that false positives appear more frequent as a result of multiple testing. This is why a couple of years ago, a friend of mine, Cam Harvey, who also is the president of the American Finance Association, published a paper with this shocking conclusion. Most discoveries in finance are false. It's just a matter of nobody's controlling for the number of trials. It's just nobody even knows how many trials are taking place. Now, when it comes to strategy development, it's something that we need to keep always in mind. We will always find profitable strategies even where there are none. It's just a matter of trying and trying, and I guess some people express this thought in the following ways. If you torture the data hard enough, eventually the data will confess whatever you want. And this is the application to strategy development. What can we do about it? Well, this is the false strategy theorem is a theorem that some colleagues and I proved in 2014. Essentially, what it determines is this dashed line. This dashed line, this dashed line is the result of that theorem, and this kind of heat map is the experimental verification, right? The experimental verification, if you generate random strategies and you compute the expected maximum Sharpe ratio, actually the maximum Sharpe ratio, you obtain this distribution, and this dashed line is what the theorem had predicted. And as you can see, the theorem is very accurate for a very wide range of number of trials. Actually, it becomes even more accurate as the number of trials increases. And what is the conclusion of this theorem? That essentially there are two variables that are never reported in academic journals that are critical to determine whether a discovery is true or false. And these two variables are, number one, the number of trials, please, if you ever find a paper in any academic journal in finance that says, and I conducted 223 trials, please tell me, because it will be the first time that anybody ever reports the number of trials. Number two, the second variable that is very critical to discount for the probability of a false positive is the variance of the outcomes, right? Why is this relevant? Well, if you are conducting research that involves strategies, let's say, coming from technical analysis or counting solar spots or something, where you're using any sort of variable or intuition to make a prediction, the variance of the outcomes is likely to be very wide. So essentially, it becomes all of a sudden very likely that you will obtain a strategy with a very high Sharpe ratio. Now, when you conduct a strategy research where you stick to a model, right? You stick to some preordained notion of how the world works, now the variance is going to be much smaller, right? Because your degrees of freedom are shrunk, right? So that's something that is, these are essentially the two variables that are critical to determine whether if this positive, whether a discovery is a true discovery or a false discovery, and they are never reported. Well, when you are conducting your research, you can always keep track of these variables, right? Essentially what you would do is, and that's something that my team does, whenever someone conducts a backtest, the system automatically logs information about that backtest. Whenever you have access to information, the researcher is going to be penalized for accessing that information multiple times. And eventually, someone will arrive at my office and say, Marcos, we encountered this strategy with a Sharpe ratio of 2. And I will look to the logs and say, hey, but you accessed the data sets like 500 times. I was expecting a Sharpe ratio of 5. And come back when you have a Sharpe ratio of 5. 2 doesn't excite me. And then he will come back with a Sharpe ratio of 5, and probably he will have conducted 10,000 experiments. And at some point in time, it's good to give up. At some point in time, people should actually give up, because remember, you will achieve any Sharpe ratio you want, 10, 20, 100. 100 Sharpe ratio, no problem. It's just a matter of trials and patience, even though there is no strategy there. So what can we do about it? Well, we can compute the deflated Sharpe ratio. And the deflated Sharpe ratio is a metric that takes into account the number of trials, whether the distribution of the returns is skewed, exhibits kurtosis. It takes into account the sample length. It takes into account all these features that are very relevant. But in particular, it takes into account this SR sub 0, this variable that incorporates what is the expected Sharpe ratio under multiple trials, and we take into account the variance of the experiments. Now, a couple of days ago, a colleague of mine and I published a paper titled Detection of False Strategies that explains a procedure for estimating these two variables very accurately. So essentially what we have done is this paper will show you how you can determine whether the strategy you have computed, you have identified, is a true positive or a false positive. And as you can see in the paper, we have estimated the efficacy of the method by running millions of Monte Carlo simulations, and the method seems to be very precise. Essentially, let's say that you come up with a strategy with a Sharpe ratio of 2, and the paper will teach you how to estimate the number of independent trials that have taken place, which is in most cases much smaller than the number of actual trials. Remember the difference between actual trial and independent trial. Independent trials typically are much less than number of trials. And also, it will teach you how to cluster your trials in a way that you can compute the variance between those independent trials. And once you plug in these two variables, you will have an accurate representation of whether this strategy is something you should be investing in or not. Is this a statistical fluke? Is this the result of luck? Or is this a strategy that performs much better than what anybody would expect just out of luck? And with that, I conclude my remarks. Thank you again for your attention. Please go ahead and ask me any questions. Yes? Definitely, they're doing a great job. And in fact, we have, for the past 3 years, we have been writing papers where we are acknowledging each other for the work that they are doing, the work we are doing. We are on the same page. Look, I think we both recognize that it is very suspicious that in finance, the rate of withdrawal of papers, right? The rate at which papers are recalled is essentially zero. Whenever a paper in finance is published, most likely it will never be revisited. And that's unheard in science, right? In medical research, the withdrawal rate can be as high as 20% in some journals, meaning that a paper comes out and 10 years later someone realizes, well, new evidence challenges what was published 10 years ago, and the paper is erased. It disappears from the journal, right? It's no longer listed there. And probably finance and theology are the last two fields where papers are never recalled. And hopefully, Cam has been a thought leader on this respect, that this must change. Thanks.
Give an example of how information can leak between two papers.
Yes. Yes. So suppose that you have a series that is serially correlated, right? And so that's what you can see there in the middle of the slide. xt is approximately the same as xt plus 1. The series is serially correlated. You make an observation, and the next observation is very similar. And at the same time, the levels are overlapping. The label that is associated with observation t shares a lot of information with the label associated with t plus 1. Now, if t and t plus 1 fall in different sets, let's say that t belongs to the training set and t plus 1 falls in the testing set, now the algorithm will learn in the testing set something that should only belong in the training set, right? And here what should happen is that observation t should be removed from the training set. So the algorithm should not be allowed to learn from something that is going to be used to evaluate the efficacy of the fit. Yep. Go ahead.
From your perspective, what do you think is going to be the key attribute for the success of trading strategies?
Yes, so the question is, what is the key attribute of success of a machine learning strategy? Well, I think it has to do with, number one, the quality and uniqueness of your data, right? You want to model strategies after data that is very hard to get, not many people have. Perhaps they are data sets that are very hard to manipulate. I know that I'm after something when my data team complains, right? When my data team complains, this data set is unbearable. Probably, it's like going to extract gold in Alaska, right? Why is there gold in Alaska? Or there was gold in Alaska because nobody wanted to go to Alaska, right? So this is a data set that is intractable, is very hard to process. So that's one thing, right? Another thing is to come up with good feature importance methods. And that's something that you can see in the book. There is a full chapter dedicated to feature importance. Why? Because research, as it relates to financial markets, backtesting is not a research tool. And I know that that's a polemic statement. Many people believe that a backtest is what should confirm or unconfirm a particular statement or strategy. But the reality is, once you are in the backtesting mode, research is already finished. You cannot learn something from a backtest and then reutilize it. If you reutilize it, well, you better keep control of the number of trials, right? And then you will have to deflate the Sharpe ratio by the probability that this is a lucky discovery. Typically, what you want to do is you want to spend a lot of time identifying what are the features that are important for that strategy. And once you come up with important features, now you're going to build a strategy, and at the last moment, you're going to backtest, and you really do not want to go into this cycle until eventually the data confesses whatever you wanted the data to confess. You want to spend most of your time in feature importance. One more.
So one of the things I read your book, by the way, fantastic book, much of it I didn't understand. But it's one of the issues that you raised in the early part is this issue of data and sampling. And across all platforms, including Quantitative, data is just data time series. There's no dollar bars. It's very difficult to build tick bars. People don't even deal with ticks because of the volume and all that.
Yep.
So it's very frustrating, actually, in a lot of ways to implement some of these techniques. I wonder if you have some comment about what some of these platforms, maybe you can convince some of these things, because it's right now the data on a lot of these platforms is pretty much your vanilla, time series information, tabular fundamental data, which you pretty much say in your book is there isn't a lot of alpha.
Well, let's think a little bit about that. It has to do a lot about how you process that data, right? You can extract still a lot of information from data sets that people have access to. In the ideal scenario, you have access to a data set that is untouched and nobody has it. But that doesn't mean that that's the only way of developing strategies. You can work with data sets that people have been working on for a long time and yet uncover strategies. Why? Because you are not using returns. Instead of using returns, you're going to use fractional differentiation. And you're going to come up with a theory before applying machine learning. Let me give you an example, a brief example. Suppose that many people in finance think that machine learning is a black box. And every time I hear that, I roll my eyes, because machine learning is not a black box. You can use it as a black box, but you can use as a black box anything you want. There is a way of using machine learning in a way that is not a black box. It's a white box, and the way is the following. Suppose that you are given some variables, and you are put in the same position as Sir Isaac Newton when he had to come up with his equation for gravitational force. So you're given this series, and you have, some series are related to the mass of the objects, the density of the objects, their reflexivity, their dimensions, their shape, the distance between objects, right? There are a bunch of variables. And now you run all these variables through a machine learning algorithm, and the machine learning algorithm comes back with the following answer. Well, there are really three variables that are important here. One is the mass of object 1, mass of object 2, and the distance between the objects. And all the rest is rubbish, is irrelevant. All right. Now, Sir Isaac Newton would tell you, that's very interesting. I would never figure that out. Now, what is the equation? What is the equation that relates these three magnitudes? And the answer is, well, that's the funny thing about machine learning. It doesn't tell us the equation. It doesn't tell us the theory. It just tells us that these three variables are very relevant. Now, the way I like using machine learning is machine learning as a research tool. It tells me what are the relevant variables, and now I have to come up with a theory that is going to combine that information in order to make a prediction. So to go back to your question, I'm not so persuaded that the only way is to utilize rare data sets. Sometimes you can use data sets that people utilize, but you actually are going to learn, and you're not going to use these machine learning methods as a black box. You are actually you will try to make sense of this data in order to come up with an explanation of what's going on. So that's an example, in addition to using fractional differentiation, using better sampling methods, better labeling methods, and so on and so forth. There is a lot you can do with standard data sets. Yep.
So you have this deflated sharpe ratio.
Yes.
And can you use that to tell us that which machine learning algorithm is better than the other one? Do you have a comparison list? And also, can you tell us intuitively how you use the deflated sharpe ratio to tell us which one is false positive?
Yes. So the idea is, the idea of the deflated sharpe ratio is to take into account information of whether this is a lucky discovery, right? And as you saw in this volcanic plot that I had there, that looks like an eruption, but it's not, this heat map, you can target any sort of sharpe ratio that you want. The question is, once you have achieved a particular sharpe ratio, is this something that you should expect just out of luck, randomness? And that's what the deflated sharpe ratio does. So in the course of your research, you should keep track of the number of experiments, right? Essentially what you would do is you would collect all the returns, all the time series of returns that you obtain from every backtest. So let's say you conduct 100 backtests, now you're going to have a T by 100 matrix, where T is the number of returns per backtest, and now you are going to use that information to determine the number of independent backtests that you have actually conducted. And that's something that you can read in the paper that I published last Monday. So that's the way to extract this number here in this equation K. And the way I use this, and my team uses this, is that people conduct all these backtests, and we know that eventually we are always going to come back routinely with false positives, right? What we need to be very careful about is when we are doing a strategy on any particular data set, whether we have exhausted our luck. Essentially, we are now we are so unlucky that we have made a lucky discovery, and that's what we need to keep track of, right? And that's one way that, for instance, this community could cooperate. You don't know how many experiments someone is conducting on the same data set. You're conducting other experiments, but here is Quantopian that is able to keep track of all the experiments. So that would be one possible application. Thank you very much.
Thank you. That was great. Really appreciate it.